Hello everyone, Yana is here. Today we're going to look at the basic elements of an accounting system. A financial accounting system is designed to produce financial statements. There are three basic elements of a financial accounting system: a set of rules to record each economic event, a framework to prepare the financial statements, and controls to detect the errors. A transaction is an economic event that affects financial statements. A transaction may affect one, two, or more items within the financial statements. The rules of an accounting system determine what, when, and how transactions should be recorded, and the amount of the transaction that should be recorded. And now let's look at a couple of examples. Equipment purchased for cash. Both equipment and cash are assets, which means that transaction affects only assets. One asset, equipment, increases, while another asset, cash, decreases. The total amount of asset did not change. Equipment purchased on credit. Assets, equipment increases, same as in our first example, and liabilities or accounts payable or notes payable also increases. All transactions must be analyzed, recorded, and summarized using a framework. The accounting equation is the basis for all such frameworks. The accounting equation is expressed as assets equal liabilities plus owners or shareholders' equity. This means that all assets are either financed by the money borrowed from external sources or the money invested by the company's shareholders. Let's look at the accounting equation one more time. You will use it for each transaction that you record. Assets equal liabilities plus owner's equity. Let's get back to our examples and apply the accounting equation. In first case, when we purchased equipment for cash, both are going to be on the left side, on the asset side of the equation. And since there's no liabilities and owner's equities, there's going to be zero on the right side of the equation. For the second example, we purchased equipment on credit. We have an increase in equipment, assets, and we have an increase in liabilities. So we will have 1,000 on the left side of the equation and 1,000 on the right side of the equation. Remember that the accounting equation must balance. The ending cash balance on the statement of cash flows must equal the ending cash balance on the balance sheet. The net income on the income statement must equal the net effects of revenues and expenses on retained earnings. We are going to use this template for all our transactions. There are several sections on this template. We have a section for the statement of cash flows. We have one for the balance sheet, and notice it includes the accounting equation. And we also have a section for the income statement. In the middle, you will see a section for all transactions. By examining the integrated financial statement, we can see the link between the balance sheet, income statement, and statement of cash flows. The left-hand column shows the effects of the transactions on the statement of cash flows. This column forms the basis for preparing the statement of cash flows. The ending balance of cash from statement of cash flows equals the cash reported under the asset side of the balance sheet. Thus, the statement of cash flows is integrated with the balance sheet. The right-hand column shows the effects of transactions on the income statement. This column serves as a basis for preparing the income statement. The net income for the period will ultimately become a part of retained earnings column for the balance sheet. Thus, the balance sheet is integrated with the income statement. Thank you for watching the video, and I hope you found it helpful.